The market was rocky here today, much of it caused by what had been a leadership group within the market. Stocks like Apple and Microsoft and other mega cap tech stocks really suffered today compared to the rest of the market, and that had not been a normal occurrence. So we'll see if that leads to a further pullback here as we head into the fall, and we'll take a look at what that means for our posture. We'll then get into a trade application example of a stock that was basically flat today, so it outperformed the market today, and is part of a theme we've been picking up on in some of my classes towards homes and home building and home furnishings. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 23rd, 2020. First of all, if you're new, remember to go over to YouTube, click subscribe. While you're over there, make sure you sign up for our email distribution list, which you'll find in our description area. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet over on Twitter for us for these Market Outlook related posts. It helps encourage additional viewership and additional eyeballs on our business here. So we do thank those of you that do that on a regular basis. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address you see embedded in the logo there in front of you. All right, let's go ahead and jump into our charts now. And as you can see, I've got chart 6D pulled up here in front of us. And we had a sharp pullback here today. This was actually the worst day for the market since June 26th. So you will see here I've got the S&P 500 pulled up. We were down 1.23% today. And as we look at that on this kind of middle portion of the graph, this will show us whenever we've moved at least 1% in either direction. And with this red bar coming down and closing below this blue horizontal line, that is the 1% price move. So in that case, since it's a red bar, it's a 1% down move that we experienced here today. And it was the biggest move we've had lower since going back here on June 26th. We've had a few larger days or up moves more than 1.23% since then, but this is the biggest down move. So obviously it hasn't ruined the trend. We continue to be in an uptrend. We continue to form higher highs and higher lows ever since bottoming there in March, but it is a healthy reminder that there is still a lot of debate back and forth as to what direction the market should be going. And today the bears seem to have their tenterhooks in that situation a little bit more than they have traditionally. The VIX did rise today, no surprise there. Typically when we have a big down day, we do see the VIX go up to reflect that fear and perhaps some additional hedging that might be going on in the options market. And so the VIX did close at 26 today. Now remember, that is a far cry from where it was back here at around 80 back in the middle of March. Nonetheless, it is a little bit higher than where we were trading just yesterday. So let's go ahead and take a look here at another chart. I was going to pull up the visualize tab here as well, just to kind of get a sense and show you that it really wasn't that violent of a day for the average stock. You know, when you see the S&P 500 down by more than 1%, your first suspicion might be that the market really got whacked. And the reality of the situation is because we had so many up moves out of the mega cap companies in recent months and years that they are more influential today than they really ever have been, at least in the last several decades. The top 5 companies in the S&P 500 dominate the market cap rankings by a long shot. And so your Apples and your Microsofts and them, they're going to have an outsized influence on the market in either direction, either up or down. Typically, we are kind of talking about that concept when we're talking about the fact that, you know, those 5 big tech companies are kind of masking the underlying weakness of the rest of the market. Today, it was the opposite. Today, it was those 5 mega cap tech companies that really were pulling the market down more than what actually happened under the surface. So in other words, you can see up here when I pull up the S&P 500, we had about 224 of those stocks advancing or closing higher, and 280 of those stocks closing lower. Now, it's true we had a few more stocks closing lower than higher, but remember, this was a pretty ugly day. This was the worst day the market has had since, June 26. We were down more than 1%. typically on a pretty violent sell-off day, you're going to see a much greater ratio towards those declining stocks. But today it was more of a kind of a split market. It just made it look really bad out there because those really big stocks suffered more than they typically had. Now, another way to kind of look at that is, let's go ahead and pull up just 3A in this case, a swing trading chart. Here's Apple. So, of course, Apple, one of those trillion-dollar companies out there, it was down 4.55% today. So, obviously worse than the market's 1.23% drop. Microsoft was also down over 4% here today. Facebook was down 3% here today. Netflix was down 2.5% here today. And Google, or Alphabet, was down 3% today. So, those were some of the big names we've seen here recently. Of course, Tesla has been in the news a lot here recently as well. And Tesla was actually up at one point during the session 6%, but ended up falling the rest of the day and actually closed lower by nearly 5%. So you can see on Tesla's chart, you actually had a pretty big bearish engulfing candle there that engulfed several of the prior days with today's wild action after it reported its earnings announcement there. Now remember, on these charts, one of the neat functions you can have is you can build your own kind of customized chart by adding the plus sign between ticker symbols. So one of the things that you might have seen me do in the past is build out the FANG chart. And in order to do that, you could go up here to the little ticker box on Thinkorswim and type in Facebook or FB, and then the plus sign, and then Apple, AAPL, and then the plus sign, and then AMZN for Amazon, and then the plus sign, and then NFLX, and then the plus sign, and then lastly GOOGL for Google. So that effectively is your FANG chart right here. That's those 5 companies all basically blended into one single chart. And you can see it was actually the 3rd straight day for the FANG cohort to be selling off. And we haven't seen a whole lot of those situations in the past, particularly this violent of a move where they've seen to go down significantly. At least 2 out of those 3 days were. And before that, we did have one big up day there on July 20th. But before that, we had basically 5 days in a row to the downside as well. We only had one of those days that was really aggressive, so it does make it a little bit different than these 2 out of the last 3 here. But the point that I'm trying to make is basically since topping out at all-time highs for FANG here on July 13th, so remember that was 10 days ago, we've had effectively all sell-off days except for one major up day along the way. So there has been some selling pressure here in those FANG stocks, even though people haven't really been talking a lot about that here recently. Now, part of the reason they haven't been talking about it is we do still remain in an uptrend. So we don't want to make too much out of this situation, right? We're still above a rising moving average on FANG at this point. But, you could make the case that, hey, we had a double top here. We are now trading at the lowest price on FANG combined since basically going back to the first week of July. And so, that's something we're going to want to keep our eye on. You'll notice that if this were one stock, obviously it's not, but if it were, it would actually be considered to have a bearish posture at this moment. Notice that the intermediate line would be at 68 and falling on FANG. In other words, that is a weekly bearish posture. It's not strongly bearish, but it is a weekly bearish posture. So there are a little bit of flies in the ointment there with our market leaders, or at least the leaders that have kind of carried us to this point. And maybe we'll start seeing, a little bit of that transition taking place where other areas and other sectors will start stepping up to the plate. One area that I did notice that has been quietly assuming a leadership role is XLP. Now, I did talk about this, might have been last week when I was doing this video. It was the day when Walmart had a big update, and XLP really had a nice outperformance day as well. And you can see that has continued. XLP today was up on a day when the overall market was down over 1%. Not only was XLP, which represents the consumer staples sector, up, but it actually hit a multi-month high. I'm not sure if this was an all-time high, probably not, but let me just verify here. Yeah, it's not to the yearly highs it had before the coronavirus, but we are now at our highest level since basically this candle on the first week of March on XLP. Now, if we were to kind of compare that and go back over here to the 3-month view, compare that to XLK, which is kind of a view for technology, you'll notice that technology has now started to slip a little bit in the rankings. And the other big one is XLC. That's the communications. That's where you're going to see a bunch of those big internet companies. You'll notice some of these overbought cluster signals here, and maybe even some bearish divergences taking place on the near-term line down below as well. So it's not, again, I don't want to be alarmist. These trends are still more strong than they are weak. We don't see major broken support or anything along those lines, but just peculiar more than anything to see those stocks that had led us for such a long period of time now here in the last 10 days kind of taking a little bit of a breather. And without them, it makes you wonder, where's the next crop of leadership going to emerge from. Let's go ahead and take a look at our traditional foregrid here, and this is chart 4B. And as we look at this, I did want to point out that we have what's known as bullish intermediate confirmation signals on the NASDAQ and on the Dow Jones Industrial Average. So let's talk about those. First of all, notice that the NASDAQ was clearly the laggard here today. It was down 2.29%. The S&P 500 was down half of that, approximately, only 1.2%, and Dow Jones was down 1.3%. The Russell 2000 actually finished flat, so I guess you could call them the leader today, even though they didn't really move anywhere. But they did have a little bit of relative outperformance, I guess you could say. So the laggard here today was the NASDAQ, and in doing so, it's setting up one of these signals that we try to identify for you whenever they exist, and that's known as a bullish intermediate confirmation signal. And that exists when the green line is considered to have a bullish posture. And remember, that can happen in one of two ways, either just simply being in the upper reversal zone, like it is right now, or just simply rising between 20 and 80. I don't really have a great example of that because the NASDAQ has been so darn strong in the last 3 months that it's hardly even been below 80 that entire time. An example over here would be something that would look like this. Now, the Russell 2000 doesn't have a bullish intermediate confirmation signal, so I don't want you to be confused. But what I'm trying to point out here is you'll notice here the green line for the Russell 2000 was traveling higher between 20 and 80. So if that ever occurs at the same time the red line is in the lower reversal zone, that's still considered a bullish intermediate confirmation signal. So back to the NASDAQ. NASDAQ has the green line in the upper reversal zone telling us that we have a strongly bullish intermediate posture on the NASDAQ. Now at the same time, we now have the red line, known as the momentum line, which is the most sensitive of these three lines, in the lower reversal zone. So for that one, it does have to be below 20 on the day of this particular signal. So we have a bullish intermediate confirmation signal. Now you've also heard David and I discuss this idea of ideal bullish intermediate confirmation signals and less ideal bullish intermediate confirmation signals. This one is actually one of the more ideal variety. And the reason for that is the blue line, while it's not part of the official signal, it can help us understand the positioning of the signal a little bit better. You'll notice that the blue line, the near-term line, is between 20 and 50. Now, the reason we're looking at that is we want to have a healthy enough exhale to make it worth our while to try to take advantage of a buy the dips mentality. Remember, a bullish intermediate confirmation signal is effectively a buy the dips mentality. What it's telling us is that the intermediate trend is strong. We know that because the green line's in the upper reversal zone. But on a random day along the way during that bullish trend, we have a pretty big sell-off. And that's why the more sensitive red line goes into the lower reversal zone. So intermediate trend still intact. One random day of a sell-off means that that could be a buy the dip if you assume that that uptrend that's already in place continues to be in place. Now, a lot of times what we've seen is that the blue line has found itself somewhere between 50 and 80. And that occurs when there's not much of a sell-off at all, maybe just a little minor sell-off. So that's why you hear us say that the blue line being between 20 and 50 feels like it's a little bit more legitimate of a sell-off, and I think you could get away with saying that this time around. Now, I don't know if this one's going to work out any more than you do, but what I would be willing to say is that a 2.3% sell-off in the NASDAQ is pretty extreme. That's a pretty big down move. So if you're waiting for a buy the dips mentality, this is a legitimate dip. It's still an uptrend. The NASDAQ is still above a rising 30-day moving average, and it continues to have a strongly bullish intermediate posture according to the market forecast technical indicator. We now have a sell-off of over 2% in one single day. That has led to maybe more attractive pricing for some of those stocks that you felt had kind of taken off without you. Maybe some of those work from home stocks or those software as a service stocks or what have you that had been, some of the more heavy momentum types of stocks in recent weeks. A lot of them had gotten a bit extended, and maybe this is an opportunity to reload the gun if you've had a little bit of exposure to them, or perhaps start brand new positioning in some of those names in the NASDAQ there. Now, the Dow Jones Industrial Average also has a bullish intermediate confirmation signal. In this case, you'll notice the green line is not in the upper reversal zone the way that it is with the NASDAQ. So right out of the gate, what that tells us is that the NASDAQ is stronger. The trend on the NASDAQ is stronger than the trend on the Dow Jones Industrial Average. But the Dow Jones Industrial Average still has a bullish posture because the green line is still rising. It's between 20 and 80 and rising. At this moment in time, it's at 72.40 and rising according to this label that you see right here. So again, we have a bullish intermediate posture, just not quite as bullish as the NASDAQ. And at the same time, we see the red line in the lower reversal zone. So that does signify a bullish intermediate confirmation signal on the Dow Jones Industrial Average as well. In this particular case, the blue line, you'll notice, is not in that ideal location between 20 and 50. Notice that the blue near-term line, according to the label, is at 56.94. So it didn't quite get below 50. In other words, yes, this is a bullish intermediate confirmation signal, but the exhale may not be deep enough to encourage you to take a buy the dips mentality. And again, that kind of makes sense. The NASDAQ was down 2.3% today. The Dow Jones Industrial Average was only down 1.3% today. That's still a pretty big day for the Dow Jones, but for some of you might say, you know what, I kind of need a little bit more of a pullback than that before I get excited about the pricing of the securities within the Dow Jones Industrial Average. So I'll leave that up to you to decide, but I thought that was an interesting educational example, comparison side by side to help you understand that signal a little bit better, what you're hoping to accomplish with it, and how do you judge it in the case of ideal versus non-ideal. Now, with the other charts, we don't have that bullish intermediate confirmation signal, but we do continue to have bullish postures. So despite the sell-off in the S&P 500 today, the green line is still in the upper reversal zone. We still have a green background color of the chart to signify that we do have a bullish posture there. And we continue to have a bullish posture on the Russell 2000 as well. In fact, I do have one new piece of information to share with you on that front, and that is that the Russell 2000 now has a green moving average tip. And remember, what that signifies is price above a rising moving average. Notice that yesterday the moving average was yellow. The reason for that was the moving average was falling yesterday and price was above it. Well, we've now gone up above that moving average enough where the moving average is starting to respond to that positive price action. Remember, a 30-day moving average is basically a lagging indicator because it's looking at the last 30 days. And so we now have spent enough time above the moving average that the moving average has decided it wants to start curling higher here. So that's a positive sign for those of you that are looking for the small caps to start supporting this market a little bit more here. Let's go ahead and now take a look at some 12 grid analysis, starting with our asset class 12 grid, and this will be chart 5A. Now, as most of you are aware, I've been talking a lot about gold mining companies and gold itself for the last several months because it's been a very intriguing area of the market to me. It's been an area that we've taken lots of trades on in this particular class, or in this presentation, I should call it. And so it's an area that I try to keep my eye on because it's an area that continues to work. And if it continues to work, continue to push into it. I was actually pretty close to putting on another gold trade here today, but the stock that I was thinking about is reporting earnings after hours today, and that's Yamana Gold, ticker symbol AUY. And I kind of like the little breakout here. This is a smaller price stock, so you got to be a little bit more careful with it. It's only a $5.80 stock, but I like the breakout in Yamana. We had a pullback of 3% today, but the bottom of that pullback zone was right at the right at the breakout zone. So it pulled back to that breakout zone. That's known as a breakout retest, and it did not continue to slice through there. Now they did report earnings here just after hours. It does look like the market so far likes what they see because the stock is trading at $5.92 at this moment in time, so it's up 12 cents since its closing price. But that's one that you can kind of take it in there as a honorable mention, as a trade idea here in tonight's video for those of you that are looking for additional gold exposure. Maybe that Yamana gold chart could be a useful one for you there. But GLD itself is a quite valuable chart. And remember, GLD tracks the price of gold. Yamana and Newmont and Barrick and all those types of companies, those are companies that try to extract gold and sell it. Those are the mining companies themselves. But if you just wanted exposure to the commodity just purely, then GLD would be one way to facilitate that. And we were up another 0.88% today. And remember what I said on Tuesday, which was this candle right here. We were already at 7.5-year highs just on Tuesday. Well, it went up huge yesterday, and it went up huge again today. So, we continue to scale higher and higher on gold, and continues to be a very interesting trend for those of you that have been fortunate enough to tap into that gold mine of opportunity here in the last several months. Now, remember, part of the reason for the strength in gold is what we're seeing in the chart to the left, which is the US dollar. When the US dollar continues to fall, like it has, it continues to support gold prices, which are priced in US dollars. So in a way, if you are somewhat bullish on gold, you are at the same time bearish on the US dollar, or at least that's what you would prefer. Now you will notice that we're getting to really extreme sell-off territory here with the US dollar. This was actually our 4th straight day of oversold cluster signals. Now we're using UUP, so you remember you could pull up the dollar versus the euro or the dollar versus the yen or what have you if you wanted to, but we use UUP as kind of a basket of other currencies versus the dollar. And we now have had 4 straight oversold cluster signals. Now notice we also had that same occurrence back here in the first week of June. It did get followed up with an up day immediately after that 4th cluster, but then we had 3 more sell-off days immediately after that, and 2 of those 3 days gave you other oversold cluster signals. So point is, yes, we are kind of getting a little bit extended and further away from that falling moving average, where you might start thinking that we could have a little bit of a reversion to the mean type of a rally in the US dollar here, let's say in the next week or two. But if that occurs, I am still assuming at this point that that downtrend is going to hold. Now what that can also mean is if the US dollar does revert to the mean and goes right back up to this falling moving average, I'm going to assume it's going to fail there. What can happen at that time is gold may very well sell off and kind of start coming back down to where it broke out here maybe a couple of weeks ago. And if it starts stabilizing around that area and it looks like it's going to bounce up and off of its rising moving average at the same time that the US dollar is bouncing down and off of its falling moving average, then I think there's an opportunity there to kind of reload with additional bullish gold trades at that moment in time as well. So keep your eye on that possibility. I'm not sure that's going to happen, but it certainly is a stronger possibility knowing that the US dollar is at a really oversold moment right now, and to get a quick 1 or 2 week rally wouldn't be entirely surprising at this point. Now in terms of other charts here, the falling US dollar has a tendency to help support foreign prices as well. And you'll notice that the foreign bond market, which is BNDX, has continued to go up at the same time the US dollar has gone down. And you can see that EFA, which represents developed foreign stocks, and also EEM, which represents emerging foreign stocks, have continued to be in uptrends while that dollar has been falling as well. In fact, today you can see that EEM and EFA were both down exactly 0.8%, while the stock market in the United States was down, effectively 1.2%. So, in other words, the foreign stock market did outperform the U.S. stock market, and part of the reason behind that may be that falling U.S. dollar there. One particular stock that I happened to stumble across that looks pretty nice in the developed foreign stock world is ticker symbol UL. This is Unilever. It looks like it reported earnings today, but that was a heck of a breakout there for what is typically a very quiet and sleepy consumer staple company. It was up about 7% here today. Remember, that would be a company that's somewhat equivalent to like a Procter & Gamble, but they're headquartered over, they actually have a dual headquarters in both England and the Netherlands. So anyway, that's one stock that has continued to trend higher. I also noticed that Nestle has been in a nice uptrend here recently. So there's a few foreign stocks out there that might capture your interest as well if you're looking for those types of opportunities. Now you'll notice that the long-term U.S. Treasuries did have a big day today. It's worth mentioning here. It was up, the TLT in this case was up 1.17%, and that was at the same time that the U.S. Treasury yield fell to what effectively is a 3-month low. It is now priced at 0.58% on the 10-year Treasury yield. And remember, you will oftentimes find that when the U.S. dollar is weak, it's at the same time when the Treasury yields are falling, and vice versa. So those two kind of together falling at the same time does tend to make sense to me. And that's a nice little reversal you see there over the last 3 months in TLT. Kind of gives you the impression of an inverted head and shoulders pattern that's been completed over that entire 3-month period there, and it looks like it's poised for continued success going forward. All right, let's go ahead and now take a look at our sectors, and for that I'm going to pull up chart 5C. This is our U.S. sectors 12 grid. We got positive news to share here. Now remember, this is the market cap weighted version, so it's not an equal weighted version, so this will have a little bit more emphasis on those Apples and Amazons and Microsofts of the world. But regardless of how you spin it, we have positive action. All of our charts are green. Now, not all of them are dark green. We do have the financials and energy and real estate as that light green background color, telling us that we have a weakly bullish posture on those. The others are considered strongly bullish. I've already somewhat addressed what I think of as one of the sneaky strong stock plays or sector plays at this moment in time, and that's the consumer staples. I just don't hear a lot of people talking about it. But the consumer staples, you look at this chart down below here, we are clearly etching out a series of higher highs and higher lows. Remember, we have seen food inflation. That's one thing that has come from a lot of these earnings reports we've seen in the last several weeks, is that food prices have gone up as we've been going through this strange moment in history where a lot of consumer staples were being hoarded. Another stock that besides UL that did well in that space today was Kimberly-Clark. Kimberly-Clark had their earnings announcement, and remember, Kimberly-Clark is a company that supplies toilet paper, and we all know that toilet paper was in high demand earlier this year, and they're getting the benefit out of that move here today from that perspective. So we've already talked about Clorox many times in the past, and actually taken bullish trades on Clorox as well. That's another one of those stories that, along with toilet paper, the Clorox wipes were also one of the strong performers during this particular era here. And then, of course, all those companies that sell them, like Walmart has been doing reasonably well, and Kroger is up there near 3-month highs as well. So, you do have a number of those consumer staples that are just quietly becoming leaders in this market. I know they're not quite as fun to talk about as the software stocks and the internet companies and all of that, but hey, it is what it is. There is strength in the consumer staples right now. In terms of other charts here, what I would say is that the two that stand out to me are the two that I've mentioned before: communications and technology. that I want to keep my eye on, because although they continue to be considered bullish postures, there's been weakness in the last 2 out of 3 days that's been above average for them, and it does make me wonder if we're poised for a little bit of a setback in those areas. And since they had been leadership areas of this market, there could be some negative reverberations as a result of that. Again, hasn't happened yet, but we want to keep our eye on that story. One thing that I pointed out on Tuesday when I did this video was that XLK, or technology, I should say in general, did slip pretty significantly in my sector selector rankings from last weekend. And at this point, I have no reason to believe that they're going to improve their rankings when I put it together this weekend. So we've already been starting to see a little bit of a stumbling there out of technology. All right, let's get into our trade application example here for the day. And for this, I'm going to come on over here to, and before we leave here, I just wanted to point out real quick, discretionary, you can see, is clearly in a strongly bullish posture over here. Pointing that out really quick because this particular stock happens to be a consumer discretionary stock that I'm about to talk about. And this is going to be a company that not a whole lot of people probably pay attention to in the stock market, but is probably a company that many people are familiar with generally as shoppers, at least here in the United States. And the ticker symbol is SNBR. Now, I do remember that once upon a time, it might have been like a year ago at this point, but I do know that I did place another trade in this Market Outlook video on Sleep Number before. It's been a long time, probably a year. Caught my eye this time around because, first of all, you can see that today it actually closed flat. So it was technically down 1 penny. If you want to call it down, feel free, be my guest. But let's call it flat for all intents and purposes. On a day when the rest of the stock market, including the NASDAQ composite, where Sleep Number would be traded from an exchange perspective, was down significantly. Yet this one was basically flat. So there was outperformance here today from this particular security. And that outperformance was enough to actually change the near-term posture on the blue line on the market forecast from pink to blue. What that means is that the blue line is rising and is now considered a bullish posture there. And one thing that we've been kind of picking up on in my classes here at Market Scholars for our premium members is that there is real strength in everything surrounding the home right now. Some of those areas we've discussed in my classes are stocks like Lennar, stocks like Pool, stocks like Trex, or their newest competitor that just did an IPO recently, AZEK. Those are decking companies. Stocks like BCC, which we talked about in one of my classes here recently, Boise Cascade. This is a lumber company that sells a lot of lumber to build homes. Stocks like Lowe's, stocks like Home Depot. These companies are largely in uptrends. And so one of the things that people have apparently been spending their money on while they've been kind of quarantined in their own homes is their home itself. I suppose they figure if they're going to be spending 24/7 in their home, they might as well enjoy their experience. And one of the ways you can kind of upgrade your home, or if you're building a brand new home and you're moving out of the congested downtown city skyscraper and moving out to the suburbs and building your own home, well, you need to fill that up with a bunch of beds and mattresses and things like that. And Sleep Number, of course, is one of those companies that would be thrilled to sell a mattress to you. And so I like the fact that this stock is, in my opinion, in an uptrend. It's been above that rising 30-day moving average for basically 3 months at this point. And you can see a fairly clear path of higher highs and higher lows etched out. And at this point, we topped out here when it reported its earnings last, here on July 15th at about $54.83, and has really sold off since then. So we've given back quite a bit in that particular security, as it is now a $45 stock. So it's down almost $10 per share, and is maybe considered more attractively priced now, right? You can save money by buying a stock when it's sold off. Doesn't mean that you should do that every time, but if you have a reason to believe that the sell-off will not continue going forward, then maybe there's a reason to get more excited about buying a stock for $45 instead of being the bag holder that bought it at $54. So I like the fact that this stock has sold off to more attractive prices, but where it looks to be stabilizing is right on that rising 30-day moving average. 3 out of the last 4 days, we've had these long lower shadows on these candlesticks, suggesting that there have been buyers interested in scooping up opportunities within these stocks at opportune times throughout the trading day. Now, when it's all said and done, those candles are still red, so the stock is still selling off those days, but they're not closing at the ultimate lows of those candles. And I think that's somewhat of a bullish sign that we see there. So today, the lowest point on that candle was at $44.05, and that was just slightly below or maybe right on that 30-day moving average. So in other words, it seems to me that someone is out there willing to buy this stock at that rising moving average because they're assuming it's going to be used as a support bounce area. You'll also notice that it coincidentally kind of is right around the same area where it topped out back here on June 29th. So the old idea of old resistance becoming new support could come into play at this area here as well. So an idea that I thought we could go with here is a little bit more of a speculative one than some of the other things that I've done. Remember on Tuesday I did the sold put on what was it? It was on Smucker, SJM. And you can see that stock has now gone up for the 2 days since then because they were, raising their dividend was part of the reason behind it. Smucker is a really boring company. You're going to fall asleep if you keep on looking at a chart like that, peanut butter and jelly. Sleep Number is not that way. I know mattresses aren't all that exciting either, but this stock is quite volatile. I've watched it, I've witnessed it over the years. In fact, I remember back in the day when it was a $5 stock, this was like 20 years ago. I happened to be living in the hometown where this company was headquartered, so I've had it on my radar for a while, and I know it's a wild stock, and it can be whipsawy. It's not the most liquid company out there either, so you got to be a little bit careful on that. But when it does start moving, it moves in a hurry. And so that's why in this case, I thought what we would do is a long call spread. And with a long call spread, it is directional in nature, right? It's going to be different than if I had suggested a bull put spread, where you sell and receive a credit up front, and you basically just need the stock to kind of behave itself, but it could go nowhere and you could make money off of it. This is not that situation. This is a long call spread where our advantage is we don't have to tie up a whole lot of capital in order to put it on, but our downside is we do need to have that stock make a move, otherwise we're not going to make money off of it. But if it does make a move, we should be able to make more money than we are risking. So that is kind of the benefit there. It's a lower probability trade, so there's a better chance than not we would end up losing money on 10 of these trades. If we did 10 of them, we'd probably lose money on more than 5 of them. But if you do hit it right, and if my hunch about a support bounce here is accurate, then what we have as a benefit is that potential to make more money than we are risking. So let me show you what I've selected over here on the trade tab. What I've done is I've gone out here to the August contracts with 29 days till expiration. So this is a pretty quick little trade here. It's only going to be on for the next month or so. And I've selected the $45 call to buy, and that's this one right here. It's a pretty tight spread for this type of a company. 330 on the bid, 360 on the ask. Now I've combined that with selling the $50 call. And again, a fairly decent bid-ask spread there. It's not, Apple, obviously, but, this is not a company that is all that well known. It only traded 500,000 shares in the stock today. So I think you have adequate options liquidity for a stock that does not trade all that much. I think this is a trader's toy here. This is a stock, as I mentioned before, it can make some big moves back and forth. So you have a little bit more company in the options world as a result of more speculation on this particular security. So when I combine those two things together, where I'm buying the 45 call in August and I'm selling the $50 call in August, that combines to have a debit of $2. So what that means for those of you that are newer to options is I'm effectively paying $200 to enter into this trade. Now, if I'm right about this and the stock really does bounce off of this rising 30-day moving average, and let's say it goes up above 50, at that point, our opportunity is basically $300. In other words, we're risking $200 to make $300. The reason for that is this is a $5 wide spread, but you have to subtract out the $2 that you're paying to access it, so that nets out to a $3 opportunity. So if we look at this chart and you think that this stock is about ready to bounce off this rising moving average and can go at least above this area on the chart right here in the next 29 days, then this type of a spread may be useful for you. Now remember, you are capping your upside at 50. So some of you might say, well, I want to shoot for 55, and you could actually have even a better reward risk opportunity situation there in that situation, but the probability of success would be lower for you as well. So by selling the 50, I'm able to kind of finance part of the purchase, and I can take in an additional, $1.40 or $1.50 or thereabouts for being willing to sell at 50. But some of you might just like the setup good enough where you don't even do the spread and you just buy the calls outright and just cross your fingers that the stock just starts skyrocketing where you don't have any cap to your upside. But in this case, just thought it would be good to kind of mix things up. I don't do a whole lot of long call spreads, so this would be a good educational example of one. So let's go ahead and click confirm and send. And as I mentioned before, our max loss is the $200 we spend up front, but our max profit possibility is $300. And so we would have the opportunity to make more money than we have the opportunity to lose if this thing does bounce sharply here in the next 29 days. Let's go ahead and send that off, and we'll see if we can get filled first thing in the morning. Thank you for joining me here tonight. Remember, if you got value out of tonight's video, we ask one simple thing for you. Just go over to Twitter and click like for us. You can actually do that in about 4 different places, so you don't have to go directly to Twitter. You could click the little like button there on our website when you're watching it in the little Twitter area as well. Or you could look for the Twitter icon on the email we send you, or you can also see that in the description area of the YouTube video itself, there will be a link to the tweet in question. So that's the best way that you guys can support this video and encourage us to do this video as often as possible. As many of you know, my dog, unfortunately, had surgery here today. We did hear back from the surgeon that the surgery was successful. He hasn't woken up yet, so I don't know anything about that. But anyway, the point that I'm trying to make is you can imagine I have a lot on my mind today as my dog who has bladder cancer is in surgery and trying to get some stents put in by his kidneys. And, I would have plenty of excuses not to do this video today. But because I know you guys enjoy the videos and because you guys do a great job supporting me with your likes on Twitter, I feel obligated to do that. And so if you want us to continue to do these videos, even though they're free and they don't make any money for David and I, they chew up a lot of time of our day. And if you appreciate the effort that goes into that, even on days like today where it's highly inconvenient for me to be doing it, then the best way that you can thank me for that or thank David for that is by clicking like for us there on Twitter. Thank you as always. Have yourself a great rest of the day, and I'll see many of you in my Options for Long-Term Investors class tomorrow morning. Now, just like I mentioned in the email to many of you last night, that class will start right at the market open tomorrow, half an hour earlier than normal as a result of me needing to adjust my schedule a little bit. So I'll see many of you right at the market open tomorrow morning. Take care, everybody. Bye-bye.